Hey everyone, and welcome. Today we are diving into a massive collision that's happening really right under our noses. It's the collision between the weightless world of digital code and the very heavy, very real world of physical stuff. We're going to be talking all about commodity supercycles and how you can even begin to think about investing in scarcity.
So let's just start with a number that it's almost hard to wrap your head around. $7 trillion. According to estimates from McKinsey, that is the capital that's going to be required just to build out the data centers and the physical infrastructure needed to power this whole AI revolution. I mean, to put that into perspective for you, that's almost a fifth of America's total spending on big projects across all industries. All of it concentrated right here.
And really, that brings us to the core idea of what we're talking about today. You can write infinite lines of code, but you can't just print more copper. You can't 3D print a chunk of lithium. As this digital world just explodes at an exponential rate, it is slamming headfirst into a very, very real, physical and finite wall of resources. All right, so let's start by digging into what we're calling the AI paradox. We all tend to think of AI and software as these things that kind of live up in the cloud, something totally weightless. But the reality is it's creating this absolutely crushing physical demand on our planet.
This slide just lays it all out, doesn't it? The central conflict. On the left, you've got the digital illusion. Code, algorithms, software. It all feels infinite. But then you look to the right and you see the physical reality. Every single one of those digital things depends on copper for wiring, on just massive amounts of power from our grids, tons of water for cooling, and minerals like lithium for energy storage.
And the scale of this problem it's just staggering. This is not some small little bump in demand. Projections are showing that AI data center power demand alone is set to hit 156 gigawatts by 2030. Now, just to give you a sense of that scale, a single gigawatt can power almost 900,000 homes. So we're talking about an almost unimaginable thirst for energy. And you know what? The physical world has to be the one to provide it. Okay, so let's move on and see how this all builds. We are going to uncover the massive, massive physical footprint of this supposedly digital revolution. This is where the bits really, truly collide with the atoms. So here's the crucial takeaway. We have to completely bust this myth that investing in AI is just a purely digital play. The reality is that it has fundamentally become a business of atoms. The success of an AI company, it's no longer just about how clever its algorithm is. No. It's actually limited by physical constraints, like can they get the permits for a new power grid? Can they secure enough water for cooling? And the numbers, they're absolutely breathtaking. I mean, just look at one single company, OpenAI. They've already committed to deals worth around $1.5 trillion for physical stuff. We're talking data centers, compute power, chips. This isn't software licenses, folks. This is cold, hard cash being spent on actual physical infrastructure. And here they are, the specific atomic ingredients you need. You need tons of copper for all the wiring. You need lithium for the energy storage. And just look at the water cost. It takes 500,000 gallons of water just to pull out 1 metric ton of lithium. And all of it, every bit of it, is totally useless without the power grids to connect these giant data centers to an energy source. This is an incredibly resource-heavy business. Now, this massive, massive spike in demand is what creates what economists call a commodity supercycle. It's this long-term, way above trend surge in prices, and it's driven by a huge structural shift in demand. So let's kind of break down the anatomy of one of these supercycles to really get why supply is having such a tough time keeping up. You see, the core of the problem here is just time. It's not like a software company that can scale up its servers in a few minutes. Opening a new mine, oh man, that is a decade-long process. You spend years just on exploration and discovery, then you spend even more years battling through what's often called permitting hell. And only after all that can you even start construction. So from the moment you decide you need more copper to the moment it actually comes out of the ground, we're talking 10 years, maybe more. The source material had a perfect analogy for this. The global supply of commodities. It's like a gigantic ship. And once that ship is pointed in one direction, it takes a very, very long time to turn it around. The demand from AI, it happened virtually overnight. But that supply ship, it's still trying to slowly, painstakingly change its course. So how do markets even try to deal with this massive time lag? Well, a key tool is what's called a futures contract. It's really just an agreement to buy or sell something at a specific price on a future date.
It helps everyone manage their risk. But honestly, the best way to understand this is with a simple example.
Okay, let's break this down. Imagine you have a baker. She needs flour to make her bagels, right? And she's really worried the price of flour is going to shoot up over the next year and just kill her profits. At the exact same time, you've got a flour producer who's worried the price will fall, and that would hurt his business. So, what do? They sign a futures contract. They agree on a price today for a big batch of flour to be delivered in 1 year. And now, they can both sleep at night. The baker has locked in her costs, and the farmer has locked in his selling price. That's really the essence of how futures work.
All right, so we've kind of established the what and the why here. We've got this massive demand shock hitting a really slow-moving supply, and that creates scarcity. So how might someone actually invest in this idea? Let's take a look at the different ways to do it. So this table breaks down the main options for you. You could just buy the physical metal itself, which gives you direct ownership, but also creates all these headaches with storage and security. Or you could use futures contracts for high leverage, but that comes with some pretty extreme volatility. It is definitely not for beginners. Then there's buying stocks in the mining companies themselves, but as we're about to see, that's an indirect bet with its own set of brutal risks. And finally, there's the picks and shovels approach, maybe through an ETF that holds a whole basket of companies building out the infrastructure. This can be a more robust way to play it because you're not betting on just one mine succeeding, you're betting on the whole trend of building more power grids and data centers. Now, before anyone gets too excited and rushes off to buy a mining stock, we need a really serious reality check. This next section covers what we're calling the miner's brutal truth and why this type of investing is absolutely 100% not for the faint of heart.
I mean, I think this quote from the legendary investor Charlie Munger just says it all. A mine is a hole in the ground owned by a liar. It's a really stark reminder that this is a notoriously difficult and often treacherous industry.
So what are these risks exactly? Well, look, even if the price of copper triples, your mining stock can still go to zero. How? A government could suddenly decide to nationalize the mine or slap on a huge windfall tax. Labor strikes could halt production for months. We already talked about permitting hell and massive cost overruns. It's just a minefield of risks that have nothing to do with the commodity price. And that's why some of the more sophisticated investors, they prefer royalty companies, or they focus only on mines in really stable countries.
And here it is. This is the most dangerous trap for investors. It's completely counterintuitive, but mining stocks often look their cheapest right when they're actually at their most expensive. I'm talking about the PE ratio, price to earnings. At the absolute peak of the cycle, when earnings are huge, the PE ratio looks really low, making the stock seem like this incredible bargain. But that is often the exact moment commodity prices are about to fall off a cliff and the stock gets crushed. It's a classic value trap.
Okay, this brings us to our final section, and it really ties everything we've talked about together. We're facing a pretty fundamental question about where value is going to come from in the future. So I'll just leave you with this question to think about. As these two worlds, the digital and the physical, continue to collide with more and more force, where will the true lasting value really be captured? Is it going to be in the cleverness of the algorithm, which, can be copied and improved on? Or will it be in the fundamental, irreplaceable, and increasingly scarce atom?